call the meeting to order. Okay, and pledge allegiance here. I pledge allegiance to the flag. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All righty. First item is public input. If we have any public input?
We have no public.
No public input. Okay. Any correspondence?
None received.
None received. Okay. There was nothing from the last meeting on anything special that we should have had in September, October, or public correspondence there or anything, right? No.
Correct.
Okay. A consideration of the minutes from the July 17th meeting. Has everyone looked at the minutes from July 17th? Anyone had a chance to look at them? And any input, any changes, any recommendations? Okay, then I make a motion that we approve them as presented. Do I have a second?
Second.
All approved?
Aye.
Aye.
Any negatives? Okay. Fiscal year 2023-24 pension valuation actuarial report, town police, WOSAP. So why don't we get into that?
Okay.
You're on.
All right. I'm Scott Lindbergh. I work remotely and we work on the town's pension plans. For both police and town employees. And we do annual valuations for both plans. And so I have the results of the 2024 valuations here, which determine the contribution for the 2025 fiscal year. So I'm going to start with the police plan. So just make sure you have that one on top. And the first page goes through some of the stuff I'm going to talk about today. I'm going to talk about the different parts of the plan that determine the liability, such as the participants and the benefit structure, things like that. And then we'll talk about the plan's assets and how they performed since last year and how they're allocated and how that determines the interest rate we use for discounting future payments back to now. And then we'll talk about the contribution and how we provide it. And then I can answer any questions. On the right, you have the key takeaways for this year. And the big story really is just that you had a high return from the assets. It was about 11% compared to a 6.5% expected rate. And so that helped move the credit ratio up to about 81%. So the plan's in good shape and making good progress. That lowered the contribution, and that was offset a little bit by the fact that there was 5 new police officers hired this year. So moving on to the next page. This page goes over the demographics of the pension plan. The chart on the top left shows the participants of the plan. And it's broken out into 3 groups. So the 3 groups are the active members in the dark blue, the bottom. Those are your current police officers that are earning benefits. And then in the light blue of that are the retirees and beneficiaries and pay status for people who are just currently receiving their pensions. And then above that in green is terminated members, or people who work for the force and then they left their job and they are owed a benefit still, but they haven't received it yet. For the police plan, there's actually only 3 people in that category. And none of them are vested for a pension benefit. They just are owed a return contribution at such point. And to the right of that chart, just there's some details on who's receiving their pensions right now and how much they're receiving. Now, down below, you have a distribution of your current police officers by how old they are and by how much service they have. And you have a fairly young group here. There's a bunch of people in the top left with not so much service. They're under 45. And then on the bottom right, you do have a handful of people who are getting close to retirement. There's about 11 of the 44 officers could retire early based on the plan provisions. And 2 of them are eligible for normal retirement. So you might see some of that coming up.
And since July 1, we've had 3 police officers retire. So there was another one that came into that hit that we had another one hit after June 30th.
Oh, but retirement?
Yeah.
Okay. Got it. And there were
What age are they eligible for retirement? Is it age or use?
it's service based.
But there's also So it's 25 years at any age, in essence. If you're 55 plus, it's 10 years.
Hey, Scott, just a quick question. The words that are upside down or backwards.
Yeah.
Can you just tell me what they are?
Oh,
I think it's head
You
count.
can't read
That's not
upside
for
down
now,
and
right?
backwards?
Not both of them together. Upside down I can.
The historical head counts,
Historical? Okay,
Yeah.
all right, I got it.
and then it just covers the 0 through 4, 5 through 9, 10 through.
Oh, I'm
14.
sorry, I just got jumbled up.
And then on the right side, something members.
Members and pay status on July 1, 2024.
Let me pull out one of these other ones so I can have a different copy here. I apologize.
And that's on both. When we get to the town one, it did the same thing for whatever reason.
Sorry about that.
Okay,
Under Queens, is there a mandatory age of retirement?
No,
There is no mandatory.
correct. It maxes out at 30. Once you hit 30 years, you max out. But it doesn't mean they have to go at 30 years. They-
No, someone could be 70 and still
Correct.
work.
Okay, so any questions on the demographics before we move on to the assets page? Okay. So the next page goes over the asset performance since last year and just gives the last 4 years for point of reference. So this year was another year of strong returns. And as such, the market value of assets and actual value of assets both increased this year. So if we start with the chart on top, you can see it's kind of bounced all over the place for the last 5 years. But if you look at the dotted green line, that's the average compounded annual return in these 5 years, and it's at 6.3%. And that's compared to our assumption of 6.5%. So on average, we're coming up pretty close to what we expected, even if there was a lot of movement from year to year. And that kind of volatility is the reason that we use what we call the actuarial value of assets when we determine your contribution. And that is simply we take the market value of assets, but when there's a difference between what the plan earns in a given year versus what we expect it to earn. So say we expect it to earn 100,000 and it earned 200,000. That extra 100,000 would be realized over 5 years. So each year we put 20,000 into the actual value of assets. And by doing so, when you have a big loss, you don't see your value of assets drop significantly, or when you have a big gain, it doesn't jump a lot. And it smooths out your contribution each year so that you just don't have these huge fluctuations. What you need.
Yeah, you're basically banking.
So after 21, when we had the 22%, obviously a ton went into that quote unquote bag. When we had the big drop the next year, since assuming a lot of the drop went into the bank, in essence, it just offsets a lot of the bank. Right?
Exactly.
Okay.
Yeah. So we're just trying to make, so if you look at the chart on the bottom there, you can kind of see the difference between the market value of assets in 2021 versus 2022. It's jumping up a ton from 13.8 to 17.4, then back down. And if you look at the actual value of assets, you get a fairly smooth progression year to year. And so that's the whole point of that.
So you're basically using a 5-year smooth?
That's correct. And so on the next page,
And that's pretty standard, what you do throughout.
yeah, that's what we do for almost all Bitcoin.
Okay. So we're not an exception or anything.
No, that's very. And the next page goes over how we got to that 6.5% something. And so this is one of the more significant assumptions that we use in our valuation, because it's what we use to discount all future payments back to today, so that we can measure the liability in a way that makes sense with funding. It's basically how much you need to invest now to pay for benefits in the future. And so we arrive at that by looking at how the plan's assets are allocated. That's what this top chart shows. Each bubble there is a different distinct asset class from the portfolio. And what it's showing is on the y-axis going up, it has the annual return, the expected return rather. And then going to the right, we have the risk level of that asset class. And so generally the riskier an asset is, the higher return you can expect to offset that risk. And we base these figures off of Milliman's capital market assumptions, which is just our internal investment group's values that we update each year. So in the middle, you have the black dot, that's the entire portfolio, and it has an expected return average around 7%. And if you look below, this is a different way of looking at it, where we kind of talked about the volatility you can see in your returns from year to year on the last page. And this just looks at the expected level of volatility over different time periods. And so it's just showing the range of outcomes you can expect. And as you go further and further out in the future to the 30-year one, you can see the range of outcomes that's consolidate around the expected return. It's that 50th percentile black line in the middle. And when we're looking at the pension, the liabilities are long-term liabilities, so we use that long-term horizon, which, so we use that 6.8% figure. Now, that's a little bit higher than what our current assumption is, at 6.5. But if you consider the last 5 years, we're at 6.3, you're kind of right in the middle with your current assumption. And if things were to work out exactly as we expect them to, it might even be slightly conservative, which puts you in a strong position funding wise, where you have a little bit of buffer. And so I don't recommend changing your interest rate at this time.
And these look pretty close to the material that we received from Morgan Stanley. They're slight differences.
Yeah, we'll talk about that next, because you have the secular and the strategic, so the 7-year outlook like Morgan Stanley, and then the 20-year
Right,
outlook.
so I'm looking at the
Morgan Stanley.
secular.
So it's different than Milliman's opinion of, you know, and if you put Merrill Lynch's and blah, 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 I mean,
Right.
Right.
you're not gonna see a huge,
But we're not,
Hopefully they're. at the
we're
same
not
level.
enormously off. They're in the ballpark.
Yep.
That's
If I can ask you, you got in this chart here on page 3, master limited partnerships. Now, I think if I'm looking at our limited partnerships, master limited, we really don't do those kind of investments.
we do.
we have
We
a
do.
5% allocation in
We do.
MLPs.
Okay,
So
and MLP.
that partnership rule, that partnership is probably what's spooking you. Which, because there's things that we don't, are not allowed to invest in that are partnerships. MLPs are publicly traded.
Okay, the publicly traded one,
Yep, yep.
and that's what's represented in.
Yes.
this chart. Okay. I wanted to make sure we didn't have something that you're piling in here that we're
Yep.
not allowed to invest.
Well,
in.
we have, Clearwater Analytics, we have daily oversight, literally daily. So once a month, my compliance officer asks me if there's any change in the investment policy statement. And literally every day, there's a guy who sits in Chicago. And if, we have international managers, there's municipal accounts are limited in what type of money markets you're allowed to invest in. So probably, once a month, we have to have a conversation with the IPS overview guy and it's never like a violation. It's always like something we just have to talk about.
Okay.
Is there any other questions on that page? Okay. This page goes over the funded status of the plan. On the top left, that chart shows the liability over time. And you can see that increasing gradually as time goes on. And that's what you expect to see from an open plan as more people continue to work for the force and continue to earn service towards their benefits.
Can I ask a question about going back to the expected rate of return? Has that changed much over time for our plans?
It's going down.
It has over time. Yeah, it came down for a long period of time to arrive at the 6.5%, and it's been there for a few years now.
And it's a great question. So the municipal market is very different than the corporate where.
Oh, sure.
Yeah,
Corporate,
right.
you have to mark to market on the
So
liabilities.
if we go back 15
Yeah.
years, it's like you had towns assuming rainbows.
Right, right.
So,
And it changes the liability.
Yeah,
It's a-
No, this is actually not that much different than the one that's used for the state pension.
correct. And so everyone's kind of come down to earth, I would say.
Yeah.
I think we were, when you started, Bob, I think the assumption was over 7, right?
I think it was closer to 8.
I was gonna
actually.
say 8 and
Around
a
8.
quarter, I'm going back 20 years,
Yeah.
but and you weren't alone at that time.
Yeah. But now it's like 13, 14 years ago when
Right.
it started here, so.
Yeah, I mean, it's been low rates for a long time.
And now on the conference call with the bond rating agencies, like this used to not be on anyone's radar. Now it's the first thing out of the
Oh, really?
analyst's
They
mouth.
want to know what you're using.
Yeah,
And they did it, we just did a bond rating, and they did ask about it. And they thought 6.5 was a little high, and my response was, we've been hitting 6.5. So we don't think it's high.
Yeah.
Yeah, yeah, to the other plan too, I think it's just over 6.5 for the last 5
Yeah,
years. So like
6.1,
between the
I
two
think.
plans, they're probably
Yeah.
average.
Has there been any consideration in the future of going to 6.25?
Not yet, because right now there's been some expectations of higher returns and higher rates going forward. And the Fed raised rates a few times, which maybe has stopped. But,
Before COVID, cash was 1, right? Post-COVID, cash is 5, cash is now 4.25. So the return in risk-free investments have really skyrocketed, post-COVID,
Yeah,
where's that going forward? I mean, we can talk about that all day long.
yeah. Well, that's why I brought it up, because if you go out a year, the Fed is still giving some indications that their comfort level where they want to get at
Mhm.
is around 3.5, something like that.
Okay. Right now, we don't recommend going down any further. It would be more conservative, but it's also not really in line with what we're seeing from our expected models. So if we get to a year where that goes down and rates are going down again, then it might be something we're looking into. But it would also increase the contribution.
Well, that's what I was going to get at. If we did that in the future,
Mhm.
contributions would have to go up, even though the plans themselves, not the police plan, but the town plan is shrinking
Mhm.
because it's frozen.
Right.
Police plan, though, is active and will continue to be active.
But the contribution going up, if we earn more money, would actually stabilize or come down a little bit, wouldn't it?
How do you mean?
The funded ratio would increase.
Yeah,
And then the outstanding liability.
So
would
we
decrease.
were at 10%, right? 10
That's
this
just
year
1
on the
year,
police, yeah. Wouldn't that affect contributions too? It'd bring it down a little bit,
It does.
even
yes.
though we reduced the ratio down to 6 or 6.25.
Right.
So would they offset each other, or
Um,
would it be fairly, I guess it depends on the amount of money that's in the fund and everything else.
it could, and so what you might see is like a gain each year then, because you
Yeah.
might have a lower assumption than what you're actually realizing. So each year you have to have a higher return than you think you would, and then so your contribution that year would be less than you projected.
Yeah.
But yeah, I guess that's one way to look at it.
would that affect our coverage ratio too? In other words, if you're 80% covered or 85%, would that push the number up necessarily?
If you brought the discount rate down, it would increase your liability. So in the year you do that, you'll see your funded ratio go down. And that's one reason a lot of plans are still underfunded right now, is because interest rates have kept coming down, and our numbers and contributions are based on if all our assumptions come true. So back when the assumptions were at 7.5, and the interest rates kept coming down and down, the contributions would keep coming up, and the liability kept going up as we changed that assumption. So that's where we are now.
Mhm.
Okay. So in terms of where the liability is at this year, it's very close to what we had projected. We were expecting 25.5 million, and it ended up being 25.3 million. Probably there's a little bit of a gain there. Nothing too out of the ordinary.
Do we have a sense of how our plan's funded ratio looks versus other similar town plans in Connecticut?
A lot of plans are in the 80% range right now that we work on anyways. There's some that are all over the place, but I think that's.
There are
Yeah,
some
you
that
can
are
find
pay as
some.
you go.
Yeah.
And they're surrounding you, and they're all around you.
Yeah.
So
But the 80% range is a good place to be. For sure.
Yeah. Yeah, that means we could take a year of the market having a correction, a serious correction, and would still be okay.
Decent.
And you can kind of see that too, if you look back at the asset page where there was that one that was -9% return.
Yeah, the
And
2000,
if you look at what happened with your assets, as long as it's just an isolated year like that and it bounces back and reverts to the mean, then you don't see a huge impact on your assets. So it doesn't hit your funding ratio. Let's say.
yeah, since 2000, we've had several, the 2001 to 2007, 8, 2018. So they happen every few years.
Mhm.
I think out of 10 years, you got to figure 1 year could be a -20 or 30. I mean, if you look at history, you could almost say that's going to happen and project it forward that way.
Yeah.
So you want to be conservative in order to cover those eventualities.
Right. Agreed. Okay, so the unfunded liability is below in red, and that's just the liability above minus the actual value of assets. And that just shows the amount that remains to be funded for benefits that have already been earned by officers who have passed. And another way of looking at that is the funded ratio, which I talked about. We are up to 81% now. And based on our projection from last year's valuation, we expect it to be closer, a little bit above 79%. So the plan's in good shape to do it well.
Does our plan have an adjustment for inflation? An adjustment?
So the police plan has a COLA 1% a year. It's not based on CPI, it's a flat 1%. And the town plan has nothing. So what you retire it at is what it is.
Was that negotiated, is that a negotiated thing
Yeah.
with the unions?
And that, I've been here 13 years, that's been the same. That whole thing.
You,
Well, they try to get two at one point, right? And then.
I don't know if I could talk about what's been discussed. in
Okay,
negotiations,
okay.
but probably nobody would be surprised if it hasn't tried to be negotiated in the past, but it has not changed.
On the next page, there's no other questions. This shows the contribution over the last 5 years. And I'll look at the bottom chart first, actually, because that just shows the total. And you can see the amount went up from last year, which is expected. It actually went up less than we thought it would from our projections. We were expecting it to be at 1.156 million. It's at 1.4. So there's a slight improvement over what we foresaw. And if we look at the top chart, it shows the component parts of the contribution. Kind of gives some insight into why it ended up where it was. And so this year, the normal cost on the bottom of that, the dark green there, that is the cost associated with your active officers earning an additional year of service this year. And so that covers their benefits that they earn now. And that went up because there was 5 new officers hired in the force. It also goes up with payable, but it's based as a 11% there.
now their contribution rate, I think it's higher than the town.
Yeah, it's 7.5%.
Yeah, and the town is how much?
6.
6.
They also, but police officers get, for the first 20 years, they get 2.5%. And the town side gets 2%. So that's one.
And again, that, the differences are what the unions negotiate and all that.
Yes.
And also the fact that they're a little different because they're in the police and their service things change.
And that's why the police cap at 30 years, because for that first 20 years, they get an extra 10%.
Mm-hmm.
The next component of the contribution is the past service costs in the lighter green. And that is amortization payment on the unfunded liability. So it's essentially like setting up a mortgage payment here. It's a funded liability. And it's being paid off over a 15-year period. Currently, that was started last year. And so we're at 14 years now. And that portion will eventually pay off the unfunded liability and bring your plan to 100% funded status.
We made that change last year. We went back to 15 years, even though we would have been down to, I think, 12. Went back up to 15. There was a pension change negotiated. So the police pension would, instead of being based on the highest 5 years, an average of the highest 5, it's now the average of the highest 3, which would have bumped up our ADC up to mitigate some of that increase. And because we were down 12 years at the time, we bumped back up to 15. We talked, the board did it. I think it was the recommendation I had, but we could have gone higher and decreased the ADC more, but we didn't think that was smart. I didn't think it was smart, and the board agreed. So we did not, you'll see, we did not make that change on the town side because it's not an active plan. So.
And the last part of the contribution is just interest on those other two at the 6.5% rate. And that's just to account for the difference in when we calculate the contribution versus when it's actually paid. It's usually a year after the valuation. Any questions on that page? Okay. And this last page here shows all the things we talked about and breaks them in detail to arrive at the contribution. It lines it up next to last year's, so you can see the difference there. There's not much more to say here, really. It's a lot of what I said before about that service cost going down as the assets went up, and the normal cost increase with the new officers and came down a little bit because your time was lower this year. And so you're right at a $1.14 million contribution for the police fund. And at this point, Joe, I talk about any assumption changes that I recommend you make for the year. And there are none this year. The experience we saw in terms of terminations and retirements, they're very aligned with what our assumptions were. So there's nothing to look at there. And we talked about the interest rate at 6.5 being okay.
The
And,
expected administrative expenses, what would the reason for them dropping like that?
So the assumption for that right now is set at the prior year expenses increased 3% for inflation. And so it just happened to be a year where your administrative expenses were a lot lower. I think that might have been a timing issue where I think 2 years worth of valuation reports were paid last year within the same fiscal year. And so just based on how we calculate your expenses going
Yeah,
forward.
I think last year it actually jumped, and this is more of a return to the norm.
Yeah, I think that was why too, is because it had extra report being paid in the same year.
So in other words, if you were to project this for 25, the 38 is more accurate than the 52
I think so.
going forward.
38 plus 3%.
Yeah.
Yeah, so does anyone have any other questions on the fleet? Okay. I'll move on to the town plan. And was that issued just on the first page there, or the second page?
Yeah, it's the same.
Okay.
But yeah,
The rest
it's in
of it.
both of them, but the rest you can read fine.
Okay, so the town plan looks a lot like the police plan in a lot of ways, and so I'll go through this a little quicker. But I'll focus more on the parts that are different. So the page with the demographic information, the town plan's different, that it's a closed plan, so there's no new participants in the pension going into it. And when you look at that chart on the top left, the active members is just going down by about 10 each year.
We've already had, so it's November 20th. We've already had 5 between the town and Board of Ed retire since July 1.
Okay.
And there's at least 2 more expected that we know of.
Okay.
So
That makes
there'll be a
sense
couple more.
too, because,
Because we've been running like 8, 9 a year,
right,
other than 2020 to 2021, but people were really looking to retire during COVID.
makes sense.
So we're still looking at maybe 40 years.
Um,
Yeah, in other words, until the plan disappears.
Whoa, you only give me 40 more years?
Yeah, I know one guy.
Yeah.
it'll shrink a lot by then for sure.
Well, I'm talking about 40, if that's 4 decades out.
Yeah.
When did we terminate that plan?
2016, I think.
Yeah.
There you.
I think it was.
It was around it.
That's right.
Each
And-
union was different because it had to be negotiated. But I think the non-union was one of the last to go. I think that, well, there was one person hired after me.
Right,
And I was
August.
hired in,
August of that year.
yeah, so, but then there weren't hires for a while. So I think officially it was like 2016. So.
Do we have a 403B for?
Yes.
Town employees?
Yeah, so all the new hires are on that. With varying, it's all similar plans, but each union it's negotiated the percentages. So,
And this commission does not get involved with that plan.
no, because it's all negotiated.
There's an investment aspect to it.
Well, it's not our money, so, well, but I guess some of it is until it vests.
For fiduciaries.
So, but that's all done through FOIA. So, obviously not at this meeting, we don't have them here, but we could have FOIA come at some point if the board's interested to hear about it,
Yeah, they've been here in the past.
but, so.
The only other thing I really want to note on this page is the chart below with the distribution. You can see the difference with the police planners. Because it's close, it's a much older population comparison. And so 40% of the group here is eligible for normal retirement already through the rule 75, which means that their age and service at 75, they can retire. And 70% are either eligible for early retirement or normal retirement. So it makes sense what you're saying with a lot of retirement already this year. A good number of the group can go out.
Even if you look, the average age plus the average service is over 75.
Yeah.
The-
And again, there's no age limits, as far as work goes. If you want to be 72 and still work, you could.
Correct.
Yeah.
So the next page, go to the assets again. And there's not much difference from the police plan here, really, other than the size of the plan. And there's a slight difference in the rate of return just because of timings of contributions and benefit payments. But for the most part, this looks very similar to what the police plan had, so I won't spend a lot of time on it. You can see the average dotted line there is at 6.6%, so slightly better than the police plan. And then the next page that goes over the allocation and everything is identical to the police plan because they have the same allocation. So not anything we've said either. The liability is still going up for the town plan, and as more current employees terminate and stop earning additional benefits, and some retirees will start getting orders passing away, you will see that liability start to decrease sometime in the near future. You can kind of see it's a lot flatter than the police plan as it is over time. And the town plan's in a little bit better shape than the police plan in terms of funding. It's up to 89% this year. And we are only expecting to be a little above 88%. So it's also doing better than expected from the projections. And the contribution decreased pretty significantly for the town plan this year. There are a couple components to that. The normal cost, which was the cost for benefits earned this year by people still working, that went down because there's a number of retirements and no one's replacing them. So that amount will just continue to shrink. And the past service costs also went down just due to the experience of the liability and also the good return from the assets. So that shrunk your unfunded liability, which decreases your past service costs.
Just so the board's aware of it. So in the employee benefits line in the annual budget, so police pension is just one line. The actual determined contribution is that budget item. So on the town side, there's three components of it. The employee pension, the ADC, the town defined contribution, which for 2025 is $250,000. And the town pays in towards Board of Ed defined contribution. And the budget for 25 is $216,000. So even though we have a $100,000 decrease in the ADC, I expect the DCs are going to climb. I hope when I look at the projections of it, not to the tune of $100,000, because it would be nice to offset some of the police increase, but all that pretty much is just shifting between the two.
We would expect the defined contribution plan to keep going up.
Yeah.
We've got more people in.
Yes. Like I said, in just since July 1, we've had 5 people. I know of 2 other ones, so yeah, that's just going to jump by that.
And then moving on to the last page, it's again similar to the police budget. There's no recommended assumption changes, and it just shows the calculations of the contribution that we talked about last page.
And the same thing with the expected administration expenses. I see that drop. The same reason.
Yes.
And then they were handled the same way as far as administrative expenses go. And going forward, you're looking at more than 72 than the 103.
Yes. And it's also something we could do too, if it keeps jumping around, and we notice that again, then we could change our assumption from last year's plus 3% to something like the average of the last 5 years. And it might be a little more.
It might move it out a little.
Yeah.
That is the other piece. So this is, the town is, it's 11 years, I think now, Scott.
It's down to 10 actually.
10?
this year.
All right. So, and can you just explain what, like next year, it's not going to go to 9, right? What do we do when we get under 10?
Yeah, so next year, what I'd recommend doing is implementing a layered amortization. And so essentially, if you look at the number here, the unfunded liability is at about 4.99. And so this year, we're amortizing that over 10 years. So next year, what we would do, instead of going down to 9 and just continuing a regular amortization that way, what we would do is keep the 10-year amortization of this amount. And what we would do is create a new base for the difference between what we think the unfunded liability will be and what it actually ends up being. And so it's a much smaller amount being amortized, but what it does is smooth out anything from a big swing. So if you do have a huge market swing or something like that, and it changes the past service cost by a lot, instead of like once you get down to 1 or 2 years in an amortization period, that could like double your contribution. If you keep it at 10 like that, you'll still smooth out those differences each year over 10 years. The effect, if everything goes according to assumptions, then you'll still be fully funded in 10 years. But since nothing ever goes fully according to assumptions, the differences will be realized over a longer period of time. It would still probably be roughly 10 years before you're fully funded, but it might be 1 year less, something like that.
And I assume, next year when we meet, we'll meet beforehand and we'll kind of talk about what options we would want to present. We'll probably present a couple options to the board to see what the board wants to do for having input.
Mhm.
So.
Yeah, so I can bring more details on that next year. That's
Okay.
And that's all I have.
I just want to touch on one other thing before we get into mine, just because I have it available. So, I have back 2008 of what the pension funding percentages were. So in 2008, the town was funded at 55%, the police was at 65. If you jump to 2014 is when there was a change it was right around the time Milliman came on board, and we changed some assumptions, right? So we updated the life expectancy chart, which dropped the plans a little bit. But the other big change was the old actuary was assuming that.
Drop the
well,
funded status. of-
Yeah. Yes,
Right, I assume it.
because
increased
because the
liability.
life expectancy went up, the liability, yeah.
But actually, didn't the town go up?
So, but that's the other piece of it. So the other thing that the old one was doing was assuming that an employee retires the second they can. On the police side, they tend to. So the police went from 2013 being funded at 71% with those changes down to 64, roughly 64. The town side, people work way past the second they're able to go. So the town went from 68 to 80. So that was a big swing in there that happened then. And I think at the same time, the ADC dropped drastically for the town because we went from 68% to 80%. So, and that's just a snapshot in time of what happened there. And now obviously we're up to 89 and back up to 81 for the police. So.
And that eventually will go to 100, you said, in 10 years.
Ideally.
Yeah, ideally.
Right.
Mike said it'll get us in.
Yeah.
Yeah.
Yeah, that's
Well,
perfect segue.
Mike, isn't Hamden that on it?
Hamden.
Yeah.
Hamden had to go out and do
Yeah.
some bond funding.
Yeah, so there's a lot of towns that wish they had these funds.
Well, I don't know, Mike might want to do Bitcoin, and, you know.
The
and
state
A lot more
used
west
to-
out
The
there.
state used to not pay their
Yeah.
contributions. Too. Try being a corporate employer and get away with that.
Well,
Right,
Mike's gonna
exactly.
introduce Bitcoin, you know, from going from
Yeah.
92
Yeah,
to
right.
500,000 in 4
Right,
years.
yeah.
Okay, so
Mhm.
any other questions on the actuary reports? We set on that? Anyone, any other input? Okay, Mike, you're on for the evaluation.
Before I get into the numbers, I handed out this cash is no longer king. 2022, you guys might remember, was the worst year in the history of the bond market. And the aggregate fell over 12%. And that there's an inverse relationship with bond prices and interest rates. And, you know, when they go from 0 to 500 basis points in 7 months, you know, we had runaway inflation in the 60s and 70s, but I don't think anyone in the world thought that that was even possible or that it would happen 75. And since this has come out, we've had 2 rate cuts, 50 and 2025. So what this simply sort of shows is the history of bond market performance in rate cutting cycles. take it for what it's worth. But if you look at, you know, the strategy of the 3-month treasury, which is similar to the BlackRock short-term strategy we have, you can see there the average annualized return in double digit. And then out to the right, the muni wouldn't be relative to this meeting, but the Bloomberg Corporate Index, of which we now have half of the fixed income into something similar to that at 18%. So what has reversed here in the last couple of months is with Trump winning the election and the tariff talk, bond market no likey. The bonds were really doing well, and then the last 30 days, the reek of a return of inflation is in the air. That's not just smoke we smell, and so bond markets have sort of reset. But here's what's happened. Take it for what it is. In prior rate cutting cycles, inverse relationship with interest rates and bond prices. Think about that for a minute.
So Mike, from that perspective, are you still feeling comfortable with 20% short term?
So we went, well, that's something we could talk about because we were in 2022, we were down 3.4% because we were so short in duration. I don't want to pat myself on the back, but we held, right, exactly. But we held back on duration, and boy, did it work. Now the 20% we're now 10% in Sage, which is an intermediate term duration. The timing of that was really good. So we did a good job with that. So am I comfortable now having half in short and half in intermediate? You tell me, we're gonna have inflation. So I think it's a good place to be for now, but I would recommend, I'm going to be recommending going out I'm assuming that I'm going to recommend to continue because we were 100% BlackRock and we were 3%, 5%, 7%.
Dribbling into a longer duration.
Yep. That's what we've been doing.
We usually talk about the investment policy statement, right, in January.
Yeah, that's when we
Yeah, that's.
But
we have our meeting
that
for that.
that has just the generic. It's not the drill down. So.
Yeah.
So we've been busy in my office working with Helen Garvin. She is with First State. She is the directed trustee of the plan. So on a monthly basis, we're wiring her. Last month, we wired $233,000 for the town, $83,000 for the police. Right from there, all the ACH and bank payments are set up, and she's robotic, I would say, but she's actually really good to work with once you get over the roboticness. Having her as a directed trustee is super comforting. We've also worked with Joe Santafonte over at PFC O'Connor and Davies, getting him all the stuff that he needs for the audit, all the statement. He always needs more and more and more. And we take pride in when Joe needs something, we try to get it to him like within the hour. Not the next day, not next week. So. And we try to do that with Helen at First State too. When they need something, we can drop everything and get it to them.
What is First State? I noticed that.
Yeah, First State is they're the trustee of the plan, directed trustee of the plan. So
Where are they?
Philadelphia,
No, Delaware.
Delaware.
First State.
Sorry, yeah. Sorry. Yep.
Is that something this commission?
We hired,
no.
We didn't have a directed trustee. Go ahead.
All right, 5 years ago, I think we hired them.
Yeah, we didn't
We
have them.
interviewed a bunch of trustees and, we selected First State.
And
We didn't have a separate trustee bank.
right. And part of the catalyst of that was Morgan Stanley having such a big piece of municipal business and all of the compliance and all of the regulation and so Morgan Stanley came to me and said, they need a directed trustee. Here's a list of 11.
Carry that stuff.
Yeah.
You guys are custodying it though.
We are the custody of the assets. Yes, correct. Yep.
I think we interviewed 3 or 4.
Yeah.
We also get Scott at Milliman, a few times a month, or what seems like a few times a month, maybe it's less than that. When somebody wants to retire, he needs the rate of return as of this date, and we genuinely turn around that very quickly as well as getting any information that he needs for this meeting, the annual meeting. Yep, and the investment policy statements, which I know we want to talk further about. So that's Morgan Stanley in that compliance regulation process not only had required directed trustees for all plans, but is paying for Clearwater Analytics to have daily oversight of the investment policy statement. When I say it's daily, it's daily. I wouldn't want this guy Abe's job because I don't know how many plans he babysits. So
Is Parametric owned by Morgan Stanley?
Parametric, we bought Eaton Vance,
Oh,
and-
they bought.
and Parametric is owned by Eaton Vance. So yes,
I remember when they were founded.
yeah, so they have great stuff.
Yes,
Yeah.
I've been in this
Eaton
business.
Vance,
They have great stuff.
they do.
I thought I touched a minute. We did a deeper dive on what Scott did, but if everyone can go to page 13 of the next slide, of the next section, page 13, section 1, we have return assumptions. Okay,
Oh, wait, which section?
yeah, you're in the wrong
I
section.
was trying to remember. Oh, well,
Yeah, right. So you were in it. You were in the right one.
annotated stuff. Yeah.
Yeah, so 13.
Yeah, you're talking about 13 of 22 here.
Bingo. Yes.
Yeah, the employees.
Yep.
Town of Bethel and this wealth strategy analysis.
Yeah, I think it's important to realize, now this is Morgan Stanley's, again, we come out with what we call a strategic and a secular assumption of underlying asset class based on rolling 20-year periods. The strategic assumption is our expectation in the next 7 years. And, pension plans are long-term in their nature, so they lean towards the secular assumption, which is the 20-year rate of returns. But a couple things jump off the page, I think. Everyone is, rushing into the S&P 500. Everyone's buying the Mag 7. Yet Morgan Stanley has a 7-year, 5.9% outlook in large cap growth stocks. And in fact, we have been wrong, quite frankly, in the short term. And we think that, expectations of, some of these lower quality growth names, technology names, are grossly overvalued. You mentioned Bitcoin. I think the cherry on top of the pie is that, this morning, Bitcoin's at an all-time high.
Well, 93 at last time.
All-time high.
Yeah, it's gonna
And
hit
so
100.
you want to measure kind of risky speculation. Boy, there you have it. And then look on the annual return of the fixed income. There's the 5%. Boy, if we were sitting here 2018, we'd be looking at basis points, not even 1% in whammo. Right, we have 5% money markets now, which have gotten cut, right, as they track step for step with the Fed. You look at CD rates. The longer you go in duration on CDs, the lower the return. What's that telling you?
Mhm.
You look at the Treasury bond market, the municipal bond market in the secondary, looks the same. What's that telling you? All indications are that interest rates are going to go down. Again, up until this election and tariff talk, and now everyone's kind of scratching their heads, wondering, what's going to happen next. This came out before all that hoopla, and look at the expectations longer term. Our 20-year expectations of short term taxable cores is in that 3.9% expectation. So. Like Scott sort of mentioned, if you have a 60-40 or, if you're 30-40, whatever your allocation is in fixed income, that, these high returns are probably not going to, well, we hope that they're not here for long, because if rates are high, there's a lot of other bad things happening.
You still feel like high returns.
Yeah, right. Right.
Just compared to recent past.
REITs and the MLPs, and we'll look at what that section did in actual performance for us. But, you know, some of the highest rate of returns, and, you know, clients often will laser in on the annual return, and clients will often either choose to ignore or not understand what the standard deviation means. But I thought I'd talk about it. If everyone could jump back to page 4. We can go out to the secular, which is dead on with Scott's firm's sort of interpretation. So what is a 6.8% expected rate of return and an 8.7% standard deviation? What does that really mean? Right? If you go back to college and quantitative analysis class, is that the 6.8% is the expected rate of return over that 20-year period. What is 6.8 plus 8.7? Why did I add that together? So it is expected 66% of the time over the 20-year period at any random period, add those two numbers together to be up 15.5. Kind of like right now. Actually, we have a blown out right tail right now. In other words, the 12-month return on the plan assets is over 20%. Are we going to build our bridge on those expectations? Heck no. So what does that standard deviation also mean? Well, let's take 6.8 minus 8.7. That's negative 2%. So 66% of the time, negative 2%. Well, that doesn't sound too bad, right? Everyone would sign up for that. Well, it's when you go from right tail to left tail, negative 13.6. There's your 2022. Right? 2008 is referred to as a blown out left tail, S&P down 51%. So no one should, cry and look at misery in a blown out left tail, and no one should be partying on a blown out right tail. And we should hang our hats around that 6.8% rate of return. And as committee members, we think long term, right? So we're not like individual 401k investors who, market goes up, they move everything to the growth fund. Market goes down, they move everything to cash. Market goes down, they stop contributing. Market goes up, they can't wait to increase their contribution. Is that we can, typically boards, I work with a lot of them on a lot of different pension plans, both private and public. You don't typically have board members or investment committees with, fingers quick on the trigger to overreact.
Can I just make an observation here that I thought was interesting, looking at your individual assumptions for types of equities? You're assuming over the shorter term period that international equities are going to outperform U.S. equities. And I assume that's because there's been such a huge run up recently in the U.S.
Valuations. So
Right.
S&P is 23 times. You go overseas, it's low single digit. You go to small cap, it's low. So I think from a valuation perspective,
So that's what's driving that for the 7-year period. For the 20-year period, though, you're predicting 100 basis points over for U.S. equities, over international.
yeah. And
You're saying longer term, you expect the U.S. to do better, but in the more intermediate term.
And this is a moment in time, right? So this is a moment as the Morgan Stanley Global Investment Committee and their, Mike Wilson and Lisa Chalet and the, our people that come up with these strategic allocations. And of course, you look again, we're almost step for step with Milliman. And I look at other, I read BlackRock daily. I read Vanguard. I get the Vanguard. They actually do it monthly. And if I just covered up Vanguard, put Morgan Stanley, they're all exactly the same. So there's a lot of unique features. Moving on to the town plan, which is what I have for us employees. We go to page 4. What's cool is we have our target allocation, which we back into. We work with Milliman on an annual basis to kind of come up with it. And we have to come up with something that is going to be reasonable based on the assumption. But as money is deposited and as money is withdrawn, each of these sleeves adjust accordingly. So you'll never see all of a sudden, large cap growth has been on fire. We're not going to wake up and be at 15% allocation. And so that as the underlying slots appreciate in value, they're sold, and there's a reallocation done alongside of deposits and withdrawals. The town plan has a monthly distribution. And why do we do that? Well, we have to meet the annual, how much you take the 233 times 12. It's about half of what the town contributes. So there's a systematic distribution process to make sure that the liquidity is always there. But the investments, you can see them off by basis points. The target allocation is going to be reallocated on an ongoing percentage. Page 6. The accounts, you look at the S&P 500, it's 32% in technology. And the town pension plan is 13%. And that's going to explain, right? You guys have been following the video, I'm sure, and Meta and the Mag 7 and all the wonderful things that's going on. And since the Trump election, the regulation sort of heading into the election, a lot of those companies being broken up was in the top of everyone's mind. And post-election, boy, that doesn't seem to be, going to happen. And, the mega cap technology continues, but, I've been in this business for this is going to be my 30th year. And I remember, and I'm sure you do too, when diversification used to mean I own Cisco, EMC, and JDSU Uniphase. And this thing kind of smells like the same movie. And so we are underweight relative to the S&P 500 in technology. Next page. So how did we do for the quarter? This plan is up 2.4 million, 6%. Year to date, it says 9/30 from December 31st. It's up 4.3 million, almost 12%. Below is the custom benchmark, which is all of the investments that we have with their benchmark melded together. Over 12 months, 20%, there's $7 million gain. 5 years, 8%, and you guys can read going on. It's amazing. 7.64 is a gain of $14 million. When you look at, clients think they need to make these monstrous returns, but you look at, what single digit return does over long periods of time, and it's humbling to say the least. So that's what's happened. Turning the page, looking at all the individual managers now. So remember these managers, right? So that is our global investment management analysts, right? There's 175 people that sit in Purchase New York, Ivy Leaguers, and that GMA is monitoring all of these managers. And if a manager is going to be yanked from our system, and why would we yank a manager? I don't want to read all of them to you, but persistent underperformance relative to expectations, violation of guidelines, meaningful. Here's a fun one though. Meaningful continued loss of assets, right? So you have these red hot funds out there that if they're hemorrhaging assets, that's a problem. Significant change in staff. I mean, there's plenty of reasons why we would recommend a manager. That's when Morgan Stanley shows us alternative managers. I bring them to you when we would vote to make a change. So looking at the different managers, James Tierney, who actually I spoke to on the phone twice in the concentrated growth space, because he's the one that's is down most relative to, and here are some sort of themes of all the managers. One is underweight technology. Okay. 2 is underweight mega cap and are defensively positioned for the long term. 3 is GARP, Okay, growth at a reasonable price, right? Not growth at any price. Anchor, our mid-cap manager, Bill Rice, I've spoken to him on the phone. He's been managing the fund since 2002 and has an annualized rate of return of 12% versus the benchmark at 8.23. I read GMA's sort of analysis on the managers, and here's one that jumped off the page. Will lag when rallies are led by lower quality stocks.
This is for Anchor.
Yeah,
So that's one of the questions I had. The big
Yep.
question I had was on Alliance Post.
yeah, yeah. So,
Because I'm looking at their numbers.
the 12-month isn't bad. It's
No, I'm looking at the
beaten-
long term.
Yeah, 15. No.
Yeah.
We go longer. It's different, and it's quality versus something we can talk about for sure.
Yeah,
I'm not
I'd like
married
to
to any of these managers.
understand I just like
Yep.
to understand what your analysts are looking at there that.
I can email you the research on ClearBridge. It's only a 4-page, and it's a great summary of
Sure.
sort of
I
what. Yeah.
I would like to understand both for ClearBridge, but especially AB concentrated growth.
Yep. Grossly underperformed, no doubt about it. And so, but longer term, that like it's when Bitcoin is not at an all-time high is when AB like ADP. He also, as he told me, he got smoked with the interest rate situations. ADP has all that float that they didn't get. There's a compelling story to long term, and you've been around. A lot of times when you fire the manager.
Oh, yeah, no, I am not somebody who
Yeah.
says, oh, they've underperformed for
Right.
a few years,
Yep.
fire them. I just would like to understand.
Yep.
I think we need to understand what your analyst
Yep.
sees in them that says, despite the
Yeah.
the performance record since 2019 or however long we've had them.
Yep.
Because we don't have the real long-term.
But again, it's
performance.
it's underweight in technology, underweight in mega cap. That's the theme, right? So he has one of the Mag 7. If he had 5 of the Mag 7,
He'd be higher,
if he had 3 of the Mag 7.
The other question that I had, and this sort of surprised me when I looked at your spiders, they underperformed the index that they are replicating.
Yep.
Is that fees?
It's partly fees and it's a different benchmark. So they're very, very similar, but yes, it would be the fees.
Well, the spider, the S&P 400 mid cap growth is being benchmarked here against the S&P 400 mid cap growth.
Yep, but they're not the exact same portfolio.
Right.
They're mildly different. That's all it takes. So I mean, yeah.
It's true for the Vanguard too.
But yeah, right. Versus the CR. I mean, they're mildly different. Fuller Thaler has been fun to watch because it's something I'm not like, but the behavioral finance theory. So it's managed by Dr. Richard Thaler and Dr. Russell Fuller, and just that whole theme. I've never embraced it as much, but I'm starting to. They actually have a mid-cap manager who's killed it. I mean, they've killed it versus the benchmark, and so solid returns from our international. What jumps off the page is, I think it was Ed, because real estate gets such a bad rap in news and Class B office and yada yada yada. The last 12 months, 32%. MLPs since are annualizing at almost 16%. So, we focus so much on public markets. I thought I'd float the idea, if you're open to it, at the next meeting. Morgan Stanley, we do a ton of private, and we would have to really modify the investment policy statement.
Yeah.
But if you guys are open to hearing from regarding private equity, private credit, infrastructure, and directly owned real estate through net lease, right? And
you're
Blackstone,
talking triple
Brookfield,
net worth.
KKR, North Haven. So Morgan Stanley and my team manages $1.6 billion, and we have there's 3 of us, Mike, Roger, and Steve. we have really brought on, we have really been embracing it. And I'm the old guy in the group, so I'm like but what Morgan Stanley's done a great job of is bringing that downstream, in that when I started 25 years ago, the minimums were obscene. And the J curve, or the illiquidity, was 15 years and above. These are now, and I don't want to steal his thunder, but they're now evergreen. In other words, you can enter monthly at the end of the month with quarterly exits.
You hope.
You hope, unless the gates are thrown up.
The so-called open-end real estate. fund.
Yeah, so it's a funny doc, and you guys may be uncomfortable with it, but I think at the next meeting, I'd like to bring he represents all that product, because, and now, performance, right? So we look at, okay, somebody help them. The expected rate of return is actually highest in that product, right? And the standard deviation is, somewhat lower, but I don't know. I think it may be worth revisit if you guys are open to
At least.
hearing.
Oh, well, yeah, I think we should.
Yep.
Yeah, because times have changed, and you're right, Mike. I mean, these are more packaged products now.
So
Where you can
I
get,
just-
you got, you're not locked in for 15 years anymore.
Well, and before my heart skipped a beat, now I know what I was going to say is that, so we talk about performance. So believe it or not, year to date, the performance is not that exciting. In fact,
Well, that's true for all the private products.
but you look at 21 and 22, I'm sorry, 20 and 21, these things are up 25% with everything else. So I would not consider it necessarily for performance. However, I would consider it for a diversification aspect, which, as we all know, will enhance.
Yeah.
But there's, and so the Morgan Stanley really has been ahead of curve with them. 25,000 is now the minimums on some of these. And, it's KKR, it's BlackRock, it's Blue Owl. I mean, it's a who's who of
But again, you would put it in that
private
10%
public
range
markets.
of the 10% that we have for the,
We would have to completely modify the IPS.
Because the IPS also says that we can't have anything that's illiquid.
We would have to completely
modify.
blow up the IPS,
Yeah.
which we've done.
We
With,
wrecked some of this.
we've done it with other committees. So we actually have and it's just how you allowable and not allowable.
Yeah.
I mean, I think that's an interesting conversation for us to have.
Sure.
In conjunction with the question of whether we should continue to have Morgan Stanley as a consultant as opposed to an outsourced chief investment office where they become the primary fiduciary and selecting and analyze.
Yeah. So,
To me, they kind of go together.
yeah, if whatever modifications you want to make it on the IPS, make them. And then I got to have my legal guys look at it. I don't approve IPSs.
No, I don't think that's the issue as much as it is for this committee to decide what role they think they want to have versus what role they want.
There's not in the charter though, this came up with Dan. The charter was that, it's something we don't have to answer it now, but the charter was that the Board of Selectmen are the planned fiduciaries,
Right.
that your committee's advisory.
If we,
to the
right,
board.
but if we were to recommend going to an outsourced chief investment office rather than a consultant relationship, what that does basically is it says it's not, I mean, theoretically, right now, it's up to us to pick the asset managers. But how often do we actually get heavily involved with picking asset managers? We don't, nor should we. We're not in a position to do that. We meet 4 hours a year. It's not the right role for us. So we have essentially outsourced all of that to Morgan Stanley. But Morgan Stanley is still a quote unquote consultant. In theory, we have to approve every investment manager, but we're not in a position to do the homework on the investment manager. I mean, I did this for a living for most of my career, And it takes hours and hours and hours of working with managers to know who to hire and fire. And you guys have on staff people who are doing that for us, which is great. So it makes me uncomfortable to say that in theory, according to our investment policy statement, we're hiring the investment managers.
I can talk to Gabe,
So
Abe, and see if he's had other towns, government entities. He's the Clearwater Analytics IPS man. I can get verbiage, because this must be going on in other towns.
I have
right?
to
So-
believe it. It's happening throughout the industry.
Yeah.
And it's really a question of what can this committee actually accomplish? What are we doing in reality versus what it says we're supposed to be doing on paper? And I look at it and I say, you're supposed to be on paper, keeping on top of the individual investment managers and selecting them and approving them. But in fact, we have delegated that responsibility to Morgan Stanley appropriately.
Hmm.
We're not
Right,
in a
and we've
position
changed
to
the
do it.
IPS many times,
But,
so
but
it's not
that's
a problem.
appropriate.
Yeah.
But the question is, I don't know if Morgan Stanley has a construct that enables you to become an outsourced CIO as opposed to.
You're the first person to ask, so like to put it
I mean,
that
I'm
way.
sure they have it somewhere in
Right.
the organization. And I'm not even talking about taking this away from your group. I'm talking about operating in a different legal. That more is more in line with the reality of what we're doing. Because to me, a consultant makes recommendations, but we've got the final authority. Well, when you make a recommendation for us about an asset manager,
We've had other board members in the past be very involved in that.
yeah, but
And,
but it's a mistake.
George,
I think it's a mistake. I mean, again, as somebody who's done it for a living of my entire career, and as somebody who sits on a lot of investment committees for much larger funds than this one, we have 4 hours a year that we devote to this stuff. And you can't in 4 hours a year really be on top of who your individual investment managers are. It's like a throwback to the olden days when committees like this used to pick the stocks that we were invested in. We said, no, we'll delegate that to investment managers. Well, now the trend is to delegate the selection of investment managers. We still are responsible for overseeing what who we delegate to, let's say, does. We still retain that responsibility. We're still responsible ultimately for approving the asset allocation and the investment policy and evaluating your services. But we're not in a position to evaluate the services like the individual asset managers.
but is there, if you look at the existing IPS,
It
is there-
says we're supposed to be.
right, but if you can change it and then
Well, yeah, that's what I'm talking about.
I can submit it.
But it would be helpful to know from the Morgan Stanley point of view, whether you can operate under that contract. Whether you've
And I
got
can
it
ask
in
how I can find out.
something.
No problem.
I don't think we have individual copies of the investment statement.
It's in this,
You got it emailed to you.
we have, it's in
Today?
Mary.
Yeah,
Mary
for this
Oh,
meeting.
okay. Oh,
Yeah.
all right.
this meeting.
Yeah.
Cause I was just.
I'll
looking
take a look
through
at
it.
that then.
Yeah, it's in the packet Mary sent to us.
Mhm.
I always believe investment committees should do what they're best able to do. This is a great committee to evaluate what our overall service provider is giving us, but it's not a great committee to evaluate individual investment.
Well, I agree with that. No,
So,
we're not spending enough time on it.
Right.
Nor do we want to.
right,
actually.
exactly.
So year to date on page 10, our equities are up 17.51. Bonds, 5.31. There's the rally, right? Inverse relationship, kind of heading into the rate cut cycle. Bonds started in all turns at 14.69. Interesting to look at 2022, right? S&P down 22, bond ag down 12. We were positioned well, we took it on the chin, down 9%, but there you can see our fixed income managers down 3.4. Other number worth pointing out on this is that in 2020, the negative 15 on You might remember oil was like negatively priced and there was no consumption globally. And that's when you saw the big decline in both real estate and in MLPs. And, you know, if you remember back in those days, boy, was it tempting to hit the road on those types of assets. Only for in 2021, 40%, right? And that, you know, you saw what the returns were like.
Mike, from a formatting perspective, is it possible on this page to show the benchmarks next to each of the asset class segment returns?
I don't see why not.
We'd be adding, a bunch of extra columns. Basically.
Yeah, no one's ever asked me, but I'm trying to think because, you know, it's a system. If not, I can make it happen.
Yeah, it just see if that's a formatting thing.
Yeah. Police plan, and we won't spend a lot of time because it's the same, but why don't we all jump to page 7? And you can see the plan ending assets 21.5 million. You know, again, the return's the same. As the plan we just looked at, asset allocation is the same. We have different deposits and withdrawals with exact same managers. And then the LoSAP is a poor man's version of, using mutual funds and ETFs with similar allocation. And I just have a 1-page slide on the LoSAP showing the annualized returns going back to 2000.
Remind me what LoSAP stands for.
Length
It's
of
the-
Service Award Program.
The two volunteer firehouses have it's not a pension plan. It's a reward based on hazmat training and number of things that they do. And
They have to qualify. You have to
Yeah.
go to you have to be an active firefighter for a certain number of years, and by active, you have to go to a certain number of trainings and calls and stuff like that. It's a closed plan
Right.
currently, I think it caps out at $300 a month
Okay.
after you hit a certain age and a certain amount of service.
And we haven't had anybody, right, when was the last?
Usually, we get like 2 or 3 a year, Mary, or something like that.
Maybe
Yeah.
1 or 2.
Maybe 1 or 2.
We'll save you all the drama. I know everything else.
The value hasn't really changed that much
what's that?
over the years. It's pretty consistent.
Yeah, well, so we
But it's all mutual funds, first of all.
it has to.
Yeah, it has to be.
$500,000 account.
But the value has stayed around the 500-600.
Yeah, that's what I'm
Pretty
saying.
much. Yeah, and there's some drawdown on it.
Yep.
Now, do we put any money into that? I don't think so. do
We haven't put money
Been a while.
into it, 10 years.
Easily.
That's what I thought, yeah. But it's just self-sustaining and it'll just keep going. What's the projection for it? Do we have any projection as to what's gonna happen long term, looking out?
I think it's actually
It's kind of the
looked
wild,
at-
wild west because we don't, go ahead, Brad.
Yeah, I think the 500 is probably well overfunded based on what we're actually seeing, what's going to happen out there, but it kind of just sits there and then someday we'll have to deal with it, assuming that there's been some talk of a similar program starting or something. It's harder and harder to get volunteer firefighters. So is reinstating something like that, something that might be on the table someday? Or is it something maybe you increase the stipend that they get annually? Some of that stuff's being looked at because it is harder and harder to get volunteers. If you lose your volunteers, it gets very expensive. So,
And there's training that goes on it and everything else. You have to make a commitment to it.
and then I think if you look at who's getting into it, like South Street had large growth a couple of years ago, but I don't know how many of those people stick around. You used to have a lot of if you worked in the highway department, an unofficial rule is you had to be a volunteer a firefighter, because you were already in town during the day and all that stuff. That hasn't been the case for 20, 30 years. So now you get a lot of those guys that were in the fire departments from being volunteer firefighters and worked for the town for 30 years. So they're in their 50s, 60s, and at some point are those the people that you want running into burning buildings? You know, like, you know,
Particularly if it's your building that's.
you know, but and now the state has pushed more and more stuff to that if somebody has like a heart attack within like 24 hours of even a training, the town owns it. Or, you know, certain, if they have a stroke, you own it, you know, like, so some of that stuff we may have to look at putting into mandates of who can and who cannot do some of this stuff, because if we're gonna own the workers' comp piece of it or anything else, we're gonna own the liability of it. We have to then own whether or not that's something we want happening or not. So,
But they get their physicals every year too, right?
correct. Correct. But some of the physicals are, depends on what they're looking at. Some of the physicals is the mask fitting and all, you know, so.
There's never been any talk about having actual non-volunteer, in other words, the core of
Paid
non-volunteer.
department.
Yeah, exactly.
No, not at this, we're not there yet, but that is a concern that could someday be the case.
Town gets bigger.
How it gets, or it just, your volunteers drop off, you know?
Mhm.
Because not only if there's a fire during the middle of the day, how many people are, if everybody's at their job, some people could leave their job and go and fight that fire because their employer is okay with that. Some aren't, you know. The current chief of one of the houses works for our utility department. The town obviously doesn't have a problem if there's a fire in the day, if he leaves his day job to go over and deal with that piece of it. But that's may not always be the case.
And do we have any joint relationship with Danbury?
Yeah, there's a mutual aid. So there was a house fire, I think that was last week in town. They didn't need mutual aid for it. They knocked it down pretty quick. But Brookfield was called to come into town. So even if Stony Hill and South Street are both out fighting a structure fire, mutual aid will be called in, not necessarily to fight the fire, but be brought into town in case something else happens.
Yeah.
So Brookfield will come in and I think they park up at Stony Hill sometimes. It just,
Yeah.
if there's another call that comes in.
If I could ask the question, on this 550,000 or whatever it's here, if they do decide to bring back some kind of program, would this be just a separate standing thing that wouldn't be pulled in? Or could it be?
We're not
folded in?
even anywhere near that point. We'd have to, as part of any conversation, would look at, say we just reopen this LoSiP plan, right, as a hypothetical. What would it cost every year to fund it? That'd be part of it.
Yeah.
You know, is the 550 enough to cover what's currently outstanding?
And then some.
And then some. So would you, if we started a new plan, you'd almost have to look at like a funded ratio of it, of like what that is. What's it going to cost us yearly to fund it? Because the last thing we want to do is just go, all right, yeah, put this plan in and not fund it. You know, the whole reason you're funding it is to try to escape other paid fire department costs, you know, or help escape that. So you should then turn around and put the money here.
Yeah.
And it was originally in the VFIS, it was like a product where at the end of the life and that once the beneficiary received, they would shop and buy annuity payments. I mean, so like it was.
They took 25 or 30,000 out and they
Yeah.
set up the,
And
yep.
so is there a product now that's out there? I'm sure there is. And if it's done right, it probably works well.
Well, there was a lot of problems with the plan.
Yeah.
And the problem, one of the main ones, is the town wasn't responsible for it. They didn't take care of it. They were supposed to, but they didn't.
Also was a variable plan by houses too.
Yeah.
Yeah, that was another.
They were
problem.
making the changes when the first selectman was supposed to make the changes.
Yeah, it was not controlled at all.
Yeah.
And that all got, well, shall we say, negotiated around it.
Mhm.
I remember that. I was here during that time
Mhm.
period.
Because that
You gotta go to.
that all started, took a couple of years. You guys, that was right around when I
Yeah, it
started
took a long
years
time,
ago,
yeah.
so.
Yeah.
Alrighty. Moving on here, we're through with this.
And we got a member that has to go pick up her grandson.
Yeah,
okay.
I just.
Okay.
I'm
Not gonna be able to have a meeting the second she leaves, so let's.
Yeah. Oh, okay.
Yeah, well, I've got the regular meeting schedule for 2025 in front of me here. I make a motion that we approve it as presented.
So moved.
Any,
Second.
changes? Second? Okay, all approved?
Aye.
Aye. Controllers update, any update?
So this we added after the last quarterly meeting because sometimes I update you on what's going on and it's not really an agenda item. This is kind of just to cover our butt for future. I
Right.
don't have anything at this time.
Okay.
The only thing is we did a rating call. Bethel got reaffirmed as AAA. Why that comes up is part of it is our pensions are well funded, our plans are well maintained. The oversight's good and they're happy with it.
Yeah.
Like I mentioned earlier, they would like to see lower than 6.5, but that I feel I'm just being super conservative.
And the liability insurance, we're all set with
Yeah.
insurances. Okay.
So.
Okay, I have a motion to adjourn.
So moved.
So moved,
Second.
seconded, all in motion,
Aye.
all in favor? Aye.
Aye, aye.
See you all in January.
Yeah, all right.
Wonderful, holidays.
Yeah, January 15th.